Imagine a software company printing cash so fast it literally bends the laws of financial physics. But, its sticker price is so high that legendary investors are actively running for the exits.
Right.
Today, we are looking at something that feels less like a traditional corporation and, well, more like an alien spacecraft that just landed on Wall Street.
Yeah, I mean, it is entirely alien to traditional financial gravity. The established inspectors, like the traditional financial analysts,
Yeah.
they're just standing around the spacecraft scratching their heads because absolutely none of their standard valuation tools actually work on it.
And that is exactly the tension we're unpacking today. Welcome to this deep dive. We are exploring a massive, dual-layered financial and strategic research report focused on Palantir Technologies, specifically digging into their explosive Q2 2026 earnings, which just dropped on August 3, 2026.
It's a huge report.
It is. And the mission for our deep dive today is to answer a very polarizing question. Is Palantir the ultimate generational AI monopoly? Or is it just a brilliantly designed software company trading at a dangerously exorbitant price?
Which is the billion-dollar question, right? Or hundreds of billions, really.
Exactly. By the end of this, we want to help you understand how modern software economics are entirely breaking traditional value investing rules.
It really is a fascinating case study in cognitive dissonance for the whole market.
Okay, so before we analyze the financial propulsion system of this company, I do need to share our required promotional and disclaimer message for this deep dive. To access more advanced researches, applications, and our latest Deep Values agents, welcome to explore and join Deep Values, app https://apps.apple.com. Use app devalues aid 677-556-8608. Hand CN, found CN. Track total market temperature. Welcome to search and download iOS app Buffett Indicator from Apple App Store or Bubble Watch from Google Play. Disclaimer. All analysis is based on publicly available sources and may be subject to revisions or differing interpretations. All contents from this channel is for research and entertainment purposes only and does not constitute any investment or financial advice or service. Conduct your own due diligence before making investment financial decisions.
And honestly, that context is especially critical today, considering we are looking at numbers that, well, they defy most historical baselines for enterprise software.
Right. Let's get right into the sheer velocity of the cash they are suddenly generating. Because you really can't debate Palantir's controversial valuation without first, understanding the volume of money flowing through the door.
The volume is staggering. It's crazy. The August 3, 2026 numbers show a total quarterly revenue of $1.935 billion. That is a 93% year-over-year increase.
Which for a company of that size is just highly unusual.
Exactly. But the internal breakdown is even more striking. U.S. commercial revenue hit $764 million. That's 149% year-over-year growth.
Wow.
Right. Meanwhile, their legacy bread and butter, which is the U.S. government revenue, that grew 90% to $809 million.
Yeah, and you have to realize, when a company already operating at a massive multi-billion-dollar scale suddenly accelerates its overall revenue growth to 93% year-over-year, you are witnessing an anomaly.
Right. It's not normal.
It's not. It demonstrates that their dual-engine growth strategy, meaning simultaneously dominating both the commercial private sector and the classified government sector, it's operating at full capacity. I mean, just in the single quarter, they closed 220 deals worth at least $1 million each. Okay, but what exactly are all these enterprise companies and government agencies buying at that volume? I mean, it's not like a hospital network or the Department of Defense is just downloading a typical app or like a cloud storage subscription.
No, definitely not. They are buying what Palantir defines as the operating system for the modern AI-enabled enterprise.
Okay, what does that actually mean, though?
Well, the core mechanism driving this is a framework they call the ontology. To understand why it's selling so fast, you really have to look at how it functions. The ontology is essentially a dynamic digital twin of an entire organization.
A digital twin.
Right? It bridges two totally different data environments. First, you have the semantic elements.
Okay, semantic meaning like artificial intelligence, large language models.
Exactly. The systems that can read unstructured text, understand human language, and process visual objects. But second, you have the kinetic element.
Which are the real-world things.
Yeah, the physical real-world actions. Supply chain movements, inventory levels, live security protocols. Palantir's ontology acts as a secure universal translator between the two.
Okay, I want to make sure we visualize this properly for you listening. Let's think about a major global airline facing a sudden, massive winter snowstorm. The semantic AI can instantly read the weather reports, right?
Right.
And process the unstructured emails from, like, stranded pilots.
Yes, perfectly. But the kinetic reality is the actual database of where the physical planes are parked, the crew flight hour limits, and the available airport gates.
Right. So in a normal company, the weather AI, the crew scheduling software, and the physical gate inventory are completely siloed.
Totally separate. Humans have to frantically cross-reference them. But Palantir's ontology connects them automatically and, crucially, safely. Yeah, it allows the semantic AI to instantly understand the storm's impact and immediately execute kinetic actions. So, rerouting planes, updating crew schedules, securing gates, all without a human having to bridge the gap between 5 different proprietary software systems. It turns a static data warehouse into a live command center.
Okay, wait, I'm stuck on something here regarding how they actually deliver this to a client, like that airline. Because according to the research, Palantir has to send its own engineers to these AIP boot camps at customer sites to set all this up.
Yeah, they do.
These are intensive multi-day hackathons just to prove the software works on the client's messy data.
Yeah.
So if it requires that much hands-on, highly skilled human labor just to get through the door, are we sure this isn't just a high-priced consulting firm masquerading as a scalable software company?
That is a great question, and it was the primary loudest critique from traditional analysts for over a decade. Oh yeah, in their early days, they absolutely operated like a boutique consulting firm. They threw brilliant engineers at messy data problems, which resulted in incredibly high variable costs and persistent operating losses. But they solved that structural flaw by building a background deployment infrastructure called Apollo.
Okay, so Apollo is essentially what allows them to install a highly custom product using more of an automated cookie-cutter delivery method.
In a sense, yeah. In the old days of enterprise software, updates or custom integrations required engineers to manually rewrite code at every single client site.
Right. A total nightmare.
Exactly. Apollo acts like a central continuous delivery brain. Palantir engineers write the foundational code once at headquarters, and Apollo automatically pushes the updates simultaneously to every single secure environment, whether it's a corporate server, a public cloud, or even a military drone on a battlefield.
Wow.
By automating the deployment and maintenance like that, the marginal cost of adding a brand new client is approaching zero. They basically successfully decoupled their revenue growth from their headcount growth.
Which explains why their gross margins have pushed above 83%.
Exactly.
They're willing to absorb the upfront labor cost of those AIP boot camps because once the system is connected, the Apollo software economics just take over completely.
And this leads to the most important operational metric in the entire research report, their net dollar retention rate. It sits at 157% for the second quarter of 2026.
Okay, for context, you guys, that means before Palantir even signs a single new customer, their existing customer base increased their spending by 57% compared to the same time last year.
Right. That expansion rate proves the stickiness of the ontology. Once this universal translator is woven into an enterprise's back-end databases, their supply chain logistics, and their frontline decision-making, extracting it becomes a monumental operational risk.
You just can't easily unplug it.
No, ripping out Palantir would essentially sever the central nervous system of the enterprise. It's incredibly difficult, if not impossible, to leave once you are fully integrated.
Well, if this software is as indispensable as you say, like if extracting it would cause total operational collapse for a client, then their pricing power must be practically limitless. Which begs the question, why are traditional deep value investors running away from a company with that kind of impenetrable moat?
Because the price tag attached to that moat is mathematically terrifying to anyone who adheres to traditional financial safety metrics. This is what the analysts refer to as the deep value paradox.
Okay, let's ground this for a second. If you look at Benjamin Graham's traditional deep value investing rules, which is basically the gold standard for finding undervalued safe stocks,
Yeah.
Palantir fails spectacularly.
Completely fails.
Right. A traditional value investor looks for a price-to-earnings or PE ratio below 15, meaning you are paying $15 for every $1 of earnings the company generates. Palantir's trailing PE ratio is over 100 times.
Yeah.
One model in our source material calculates it at an astronomical 107.4 times. And Deep Value also looks for a price-to-book ratio below 1.5. Palantir's is near 31 times.
Which is just, yeah, massive.
By standard metrics, a stock trading around $124.82 with those multiples isn't just expensive, it's an absolute nosebleed territory.
It is. But you have to look at the mechanism of their balance sheet, because despite failing every valuation metric on the price side, Palantir aces every single operational safety test. They carry zero long-term debt.
Zero.
Zero. They're sitting on $8.8 billion in cash and equivalents, and they are generating cash at an astonishing rate with a free cash flow margin of 62.7%.
And the research also highlights their Rule of 40 score.
Mhm.
For those unfamiliar, the Rule of 40 is a benchmark for software companies that combines their revenue growth rate with their profit margin. If the two numbers add up to 40, it's considered a healthy, sustainable software business. Palantir's score is a record 155%.
Yeah, that massive disconnect between an impeccable cash-gushing operation and an astronomically high stock price, it creates a nightmare when you try to model out their intrinsic value.
Right, because how do you price that?
Exactly. The research package details several discounted cash flow or DCF models. And a DCF model isn't just a guess, it's a mathematical attempt to take every dollar a company will ever earn from today until the end of time and discount it back to what that money is worth today, accounting for inflation and risk.
So it's heavily reliant on what you assume the future will look like.
Heavily reliant. And the intrinsic value estimates swing wildly based on those assumptions. I mean, if you run a no-growth scenario, assuming their massive cash flow just stagnates and stays flat for a decade, the math says the stock is only worth around $16 to $19 per share.
Wow.
Yeah, and if you use a conservative growth scenario, it puts the value around $40.
But the stock is trading at roughly $125 right now. So
Yeah.
how does the model justify the current reality?
Well, to justify a $126 intrinsic value in this model, you have to run a nominal hypergrowth scenario. And if you mechanically apply their historical 96% average free cash flow growth rate for the next 5 years, the model mathematically shoots up to $375 per share.
Okay, but is that realistic?
No, the research explicitly warns that maintaining nearly 100% compounding growth for another 5 years is a major stress test of economic reality, not a realistic base case.
So at roughly $125 a share, all of this incredible, flawless future growth is already completely priced in.
Exactly.
In value investing, there is a concept called the margin of safety. Basically, buying a stock low enough that if the company stumbles or the economy tanks, you have a cushion. You don't lose your shirt. With Palantir, the margin of safety is virtually zero.
Right. The company must execute flawlessly, without a single macroeconomic misstep or competitive setback, for an entire decade just to justify the premium you are paying today.
It's like buying a structurally perfect, hurricane-proof mansion. It's the greatest house ever built. But you're paying so much money for it up front that if even one single window breaks over the next 10 years, your entire investment is completely underwater.
That captures the dynamic perfectly. And because that valuation demands absolute perfection, it creates a massive ideological divide on Wall Street about whether this stock is a time bomb or a gold mine.
Which leads us to the polarizing players involved, right? The investors, the leadership, and the geopolitical risks.
Yeah, let's start with the investors.
The billionaire divide on this is fascinating to watch. On one side, you have legendary value investor Stanley Druckenmiller. He managed the Duquesne family office, got into Palantir early, but then sold 95% of his massive 770,000 share stake in Q3 2024.
Wow.
The research notes he sold specifically because the valuation multiples expanded so far, they violated his safety principles. So he took his profits and rotated into high-yield dividend stocks.
Right. But consider the flip side with Cathie Wood and ARK Invest. She treats Palantir as a high-conviction, long-term disruption play. ARK aggressively accumulates shares during short-term price drawdowns.
Because they see a bigger picture.
Exactly. Her overarching thesis is that traditional valuation models vastly underestimate Palantir's total addressable market, or TAM. She believes the global market for sovereign AI and enterprise ontology is so unimaginably large that paying an exorbitant entry price today is easily justified by decades of compounding future growth.
Okay, so traditional value managers are fleeing the high price, while innovation funds are happily absorbing those shares. But regardless of who owns the common stock, the public shareholders don't really have any power to tell Palantir what to do. The research spends a significant amount of time on the founder's fortress.
Yeah, and this is a crucial, often overlooked piece of the risk puzzle.
Yeah.
Palantir is led by a triumvirate: CEO Alex Karp, President Stephen Cohen, and Chairman Peter Thiel. And they have mathematically immunized themselves against outside shareholder pressure.
How so?
Well, they utilize a multi-class share structure, specifically heavily weighting Class F shares, which gives these three founders just under 50% of the total voting power of the entire company.
Meaning they hold all the cards,
Yeah.
regardless of what the public markets want. The source material notes that proxy advisory firms, like Institutional Shareholder Services, known as ISS and Glass Lewis, they absolutely despise this structure.
Oh, they hate it.
These advisory firms essentially guide how massive institutional funds vote, creating a phenomenon the source calls robo-voting. They consistently urge shareholders to vote against Palantir's executive compensation packages and demand equal voting rights.
And structurally, it doesn't matter. I mean, the research highlights a recent proxy vote where shareholders actually voted against management on a proposal demanding political spending disclosure.
Right.
The advisory firms rallied the common shareholders to support the disclosure, but the founders simply exercised their super voting shares and crushed the proposal, casting 1.7 billion votes against it compared to just 609 million for it. The institutional protests are mathematically moot.
Which is wild. Having absolutely no one who can pull the emergency brake seems incredibly risky to me. Does this dictator-style corporate governance actually protect the company's long-term vision, shielding them from short-term Wall Street demands? Or is it a massive liability? What happens if management steers them into a geopolitical wall?
Well, you have to look at how they navigate global risks to answer that. The leadership team is deeply philosophical and operates with very rigid principles regarding who they do business with. The source explicitly notes that Palantir maintains an unabashedly pro-Western political stance. They refuse, on principle, to sell their software to adversarial nations.
And to be clear to you, the listener, we are impartially reporting the facts of their business model from our sources, not taking a stance on those geopolitics ourselves.
Okay.
But by drawing that hard line, they are voluntarily shrinking their global total addressable market. They are actively walking away from billions of dollars in potential revenue.
They are. The research even notes that some allied nations in Europe have expressed apprehension about integrating an American defense contractor so deeply into their sovereign data systems.
Well, that sense.
However, that strict ideological stance is exactly the mechanism that secures them the highest possible level of trust with the United States government. Palantir holds Impact Level 5 and Impact Level 6, IL-5 and IL-6, security clearances from the U.S. Department of Defense.
Which is huge.
It is. This clearance allows them to operate in highly secure, completely air-gapped, classified defense networks. That level of clearance is an almost insurmountable moat for any commercial SaaS competitor trying to break into the defense sector.
So they sacrifice a portion of global commercial sales to build an impenetrable fortress around their highly lucrative U.S. government contracts. But is that government moat enough to protect them from the ultimate wildcard? Because the research points to the open source AI community as a looming threat.
Oh, definitely. It is the permanent, decentralized risk to their entire business model. Open source AI is advancing at a breakneck pace. Decentralized developers are releasing increasingly capable large language models and infrastructure tools entirely for free.
Right.
Right now, Palantir dominates the integration layer. They are the premium universal translator connecting the AI to the enterprise data safely. But if large enterprises eventually develop the internal competency to orchestrate their own secure AI workflows using these free open source tools, Palantir's premium pricing power could erode permanently. Their integration layer might start looking like an overpriced luxury.
So what does this all mean when we step back and look at the whole picture? We are looking at an absolute outlier in the enterprise software space. Palantir is an operational juggernaut. They have a pristine balance sheet with zero debt, a record 155% Rule of 40 score, and they are generating immense free cash flow with an 83% gross margin.
It's incredible on paper.
It is. Yet their stock price carries a valuation that completely rejects traditional value investing rules, demanding a decade of uninterrupted, flawless perfection from a management team that structurally answers to almost no one.
You know, I think it's helpful to contextualize this within your own professional life. Think about the software tools your company relies on every single day to function. What is the one system that, if it were suddenly removed or shut off, would cause total operational collapse for your business?
Oh, wow.
Yeah, that intense stickiness, that total integration is exactly what Palantir has engineered. But they haven't just done it for a mid-sized marketing firm, they've done it on a global military-grade scale.
It brings us right back to our opening thought. They truly are an alien spacecraft that landed on Wall Street. Structurally perfect inside, but entirely alien to traditional financial gravity. Which leaves you with a final lingering question to ponder long after we sign off today. If open source AI continues its breakneck evolution, eventually commoditizing the very data integration layer that Palantir currently dominates, will their bulletproof IL-6 government security clearances be enough to save them? Or is the ultimate threat to this $300 billion AI giant not a rival corporation, but simply free code available to anyone with an internet connection?